Hello, everybody. Welcome to Tuesday. The S&P 500 was up 0.27% today. Kind of an important day in the sense that they readjusted the jobs numbers. So every month they come out with, from the Bureau of Labor Statistics, how many jobs were created in the month prior. And then once a quarter, they make an adjustment going back. And then once, by September, they actually do an entire year adjustment. So the adjustment today was 911,000 less jobs than were posted for the year that ended March of 2025. Which is a record. And last September, when they posted the same thing, it was over 800,000 jobs that were adjusted down. So it makes you wonder why the market responds so, drastically to the monthly number when it keeps getting adjusted pretty drastically, even on a quarterly basis, much less an annual basis. So that's the way it works. It's still, models aren't always perfect. Sometimes they're useful. The labor data is useful, but it probably needs to be, taken with a grain of salt as to how many jobs are actually being created or not in this particular case. So, of course, the market went up based on this news, which again you wouldn't expect. You would expect more jobs means better economy, better stock market, those types of things. But again, this particular market is really heavily focused on what's going to happen with the Federal Reserve. We went from maybe having one cut to now maybe having three cuts, because we've been seeing some of these numbers come out on the jobs market that's showing kind of a softening in that particular area. And so, now you've got this scenario where the CPI report is going to come out this week, which is the inflation report for consumers. And then the PPI is going to come out, which is inflation report for wholesale. And so, last time the CPI was, higher, than it probably should be, heading a little bit higher, but not too bad. But the PPI number came out, the wholesale report, it showed a pretty big jump in wholesale costs, 0.9% actually month over month, which comes out to, 10.8% on an annualized basis, just to put that into context. So, and that's what we're seeing first. We saw, the surveys from the manufacturers talking about how prices are going up. Then we saw the actual wholesale prices going up, and eventually, that's might bleed its way through to the consumers. The reports that we saw some time ago was roughly 2/3 of the tariffs were being paid by companies and the rest being paid by consumers. And that's expectation is that'll actually reverse. About a third or less of the tariffs will be paid by the either the company or the exporting company or the exporting country, and somebody besides the consumer might pay a third of those tariffs, and then 2/3 of the tariffs would eventually be pushed on to the consumer, just based on past history and how things have worked as far as that goes. So that's coming at us, and so that's partly what we might be able to start to see here. And certainly it's going to have some kind of an impact in how many rate cuts happen with the Federal Reserve, because we continue to see higher and higher inflation, even with lower job numbers. Is going to make the tough decisions for the Fed. We're heading in possibly into what's called stagflation, which is a kind of no man's land where you have very low growth, 1%, let's say, gross domestic product growth, so not a recession, but slow growth, but you still have higher inflation coming through, which the last time we really had that was back in the 70s. And so you could have a situation where the tariffs are pushing up prices higher and higher, and unfortunately also causing some weakness in the job market. And so between those two, what does the Fed choose? Do they try to stimulate the economy at the risk of causing more inflation, but obviously trying to help the job market, or do they not raise rates, and hope that the inflation gets better? So at the moment, when you listen to Chairman Powell at the last meeting, he was talking about tariffs could be temporary, not tariffs, but the bump in increased costs could be temporary, kind of a one-time thing, and that they were leaning towards really wanting to help the labor market. And certainly, after today's move with 911,000 jobs less created than thought, that makes it even easier for the Fed to decide to do that. And we're already at 100% probability in terms of the futures market's bet on rate cuts for next week. with even some probability that we might have a half point rate cut, although I would be surprised to see that. But that's what happened last year in September when we were all kind of surprised too. So we'll see what happens. But anyway, looking forward to seeing what's going to happen with the CPI number and PPI number this week. And we'll talk about that some too. But look forward to seeing you tomorrow. Thank you very much.